So this issue of under and over applied factory overhead arises in most manufacturing companies, and it's a result of the process of not knowing exactly what our overhead costs are going to be up front, and then having to apply some rate going forward to apply the overhead based on a budgeted amount using normal costing. And so what they're trying to tell us in this problem, and it's maybe a little hard for you to understand because we've used some different terminology, is that when you combine both the manufacturing overhead control account with the manufacturing overhead allocated account, we have a $100,000 credit balance. Another way of saying that is throughout the year, maybe we had $1 million of manufacturing overhead come through for items like utilities and maintenance, labor, and um, depreciation on factory equipment, those sorts of things, rent for the factory shop floor, those sorts of things came through, and those are my actual costs. And all along, as we've been creating and producing uh, jobs throughout our manufacturing process, we've been allocating overhead as they work their way through work in process. And so what we've done is we have allocated something like $1,100,000 based on the rates we've used. And so when you combine those two accounts together, what you'll notice is you have a net credit balance of $100,000 because you have 1.1 million over here. And this is a problem for us because this overhead application is simply a guess. It's a fictitious number. And this actual overhead is an actual number. And we're creating an income statement and a balance sheet and a statement of cash flows. We've got to use actual numbers. So there's a reconciliation process that happens at the end of the year where we tie out the actual amount of overhead that we've incurred with the overhead that we've applied, and we make the two match. And the easiest way to do that is to just force everything, the difference, the over or under applied amount. We would call this an over application. We're over applied here. We would force that amount to cost of goods sold. So the way to do that is to debit this manufacturing overhead allocated account for $100,000. And by doing that, then these two accounts net to zero. So the entry, when you book it to cost of goods sold, if you're over applied, is to debit, not cost of goods sold, but to debit this manufacturing overhead allocated account for whatever the over applied amount is, and in this case it's $100,000. So the credit goes to cost of goods sold. And so what we're doing is we're reducing our expenses on our income statement in the current year and saying that's the proper place to push this difference. Now we'll see why that's problematic. This is the easiest approach because it requires really no attention to any detail. It's saying that all these costs, all these overhead costs made their way through to the income statement, which is where we're now going to reconcile it from. So that's a long explanation as to how you dispose of the overhead over allocation using the cost of goods sold approach.